Venture debt is a very, very mature asset class in the US. So there are many, many giants there. The famous one being Silicon Valley Bank, Hercules Technology, Growth Capital. There's Triple Point, and many, many other smaller funds as well as financial institutions that provide venture debt. So before venture debt came to Southeast Asia, a lot of founders generally only had one form of capital when going out for fundraise. So that would be in the form of equity. I think debt financing has become even more important as a complementary form of capital. It is an alternative asset class, but I wouldn't say it's an alternative to VC money, which is the equity money. So we only provide venture debt to companies that have VCs on their capital table, raised a fresh round of funding from these VCs, then we are able to structure it in a way where what we are providing to the entrepreneurs is more money that's slightly less dilutive, or helping the company become more capital efficient. So we're almost like the de facto banker for VC-backed startups. The other beautiful thing about venture debt is a lot of founders raise it as an insurance policy. If I've raised 10 million in equity, nothing's to stop me from raising $2 million of venture debt. I may or may not use it, but it's there if I need to. Especially with COVID now, an equity round takes 2 to 3 months longer to close, right? So at least you've got that lifeline in the form of venture debt there. So venture debt in its purest form, we don't take personal guarantees or we don't establish any valuation for the founders or the round. So for a founder that's looking to raise Series A, Series B, um, typically we come in and fill the round, but we don't dictate the valuation. It would it will always be the lead equity investor that would set the valuation. So, for the vanilla venture debt, like let's think of a term loan. So we typically charge an upfront fee. There is an interest rate component, and then there is a warrant component. So warrants are a form of options that are issued by the company. So you could issue a warrant that allows you to buy X number of shares with the exercise price at, say, Series A valuation. So you have $100,000 warrant that with the exercise price at say $1,000, right? Then that gets you 100 shares. When is a company not suitable for venture debt is, I'd say, very, very high burn relative to the development, the stage of the company, and companies where there are negative gross margins. So really, there's a lot of subsidy. There's very, very thin margins where there's just no visibility on debt repayment. When is it good? If you have receivables, you have working capital needs, and you are trying to fund for growth. The risk is a company is not able to service the loans. That's when they get into default and liquidation issues. So we need to look at sources of cash for repayment, and part of it would come from cash flows generated from operations, but the other part would have to come from the VC's equity infusion. What we charge really is, I would say, a really balanced risk-weighted return. It's not cheap, but it's not over the top. I would say we are somewhere in between where the banks would charge an SME and where the peer-to-peer lenders are charging SMEs. Generally, I'd say at Genesis we tend to look at Series B and beyond, but there will always be that one or two outstanding Series A companies that are fit for venture debt. Few of the I say hygiene factor would be, we definitely need a VC investor coming in. So I assume the company raises a Series A from the well-known VCs on the street. You raise $3 to $4 million. There is proven revenues, so you've got real customers. You've got revenues with decent gross margins. We understand how you're spending money. Hopefully the variable operating expenses are higher than the fixed ones. There's no, there's no factories, there's no aeroplanes and things like that. And then we try to say, hey, look, this business model, where does it fit into the world now?
Yeah.
If today a founder comes to me at Series A and tries to convince me that we are going to build another ride-hailing company,
Mm.
I'm like, really, like, you're probably going to waste a lot of money, right?
Yeah.
Because so-called the giants are there, war is over. But there are a lot of other interesting business models that are solving real issues.
Yeah.
We'll look at it. So those are the things that we look out for.